Hey everyone, welcome to Dr. Frank's Finance World. I'm Dr. Frank, the bank, because I try to teach you something about finance that you can make money on in the future. This video is about stocks and their valuations. Please be sure to subscribe if you want the notifications out there. There's over 60 videos now, and we try to update notes with links and so forth at different points in time in the future. So in the finance world, you're trying to look up something commonly called intrinsic value and compare it to what the stock is currently selling for, the price of it at the market at that current time. And there's a couple of processes that you can go through to do that. But the one we're talking about here is the dividend discount model. And we're going to use it to try to figure out what we think the company is worth. Many people do this. Outside investors, corporate insiders, analysts, they do a bunch of different approaches, multiples approaches, and so forth. But in the end, we're trying to figure out an intrinsic value. In equilibrium, of course, we assume the stock's price equals its intrinsic value, which actually rarely happens because I think you have different estimates on what will happen. But at any rate, outsiders estimate it and help determine which stocks are attractive to buy or sell. If, for instance, you come up with a value of $30 and the stock is selling for $15, you think, hey, I can buy a $30 stock for 15 bucks, so it's a pretty good deal, and therefore it'd be a buy. On the other hand, if you find a value of $30 and the stock is actually selling for $100, then you think, wow, there's no way I would pay $100 for a stock I think is worth $30. So they're always looking at that in terms of over or under valuation. Like I said, we're going to be doing the dividend discount model here. We can talk quickly about a price to earnings multiple approach as well, but we're bringing in, again, the capital asset pricing model because we need to figure out a required rate of return to bring these values back through time to today. So this is pretty common, the dividend discount model. You just keep running dividends, in theory, as you can tell over here, forever and ever and ever and ever. But you can't do that. And really, realistically, you can only figure out maybe a couple of years into the future what are reasonable assumptions to come up with a price. Once you get past 2 or 3 years, the firm can change so much, the market can change so much, and so forth out there. So there's a lot of give and take when you come to these values. But typically what people will do is rather than just go on forever and ever and ever, they will use essentially this equation at some point in time in the future to find the value or the price of all of the future dividends. Another way of looking at that is the price that you would sell the company at the end of some period in time. So stock whose dividends are expected to grow forever at a constant rate, you can do a D1 and a D2 and a D3 and so forth out there. I actually put this in here because this is part of the structure that I use to figure out when they're not constant for a period of time and then when they become constant at some point in time in the future. But if the G is constant from time period 0, you can actually calculate the value in that simply looking one period ahead, the constant growth rate to get a D1, and then dividing it by the required rate of return out there. This has many names in finance. It's kind of unfortunate, but they call this the required rate of return. When we get to a section where we're trying to figure out the weighted cost of the money they borrow, weighted average cost of capital, they actually use the symbol K sub E, the cost of equity. CAPM is actually one of the methods you go to find it. And so there's a lot of different names for it. But ultimately, when we get the dividend, we take our required rate of return, subtract the growth rate, we will come out with the price as of today. So how do we find this R sub S or this K sub B or this CAPM? Of course, CAPM is what we use. This is the equation that you see all the time for capital asset pricing model. But breaking it down a little bit, everybody deserves a risk-free rate for not having access to their money for some period of time. But if you're going to take more risk and put your money into the stock market, there should be a premium for being in stocks. And when you take the expected return of the market, subtract that risk-free, this is essentially a premium in stocks. Sometimes that is called the market risk premium. Everything in parentheses, if you're giving everything in parentheses, is called a market risk premium. If you're only given the required rate of return of the market, then you would have to go through this calculation. But in either case, you're getting what a market addition for being in stocks is, and you multiply it by something called beta. You can calculate that using regression, the slope function in Excel, or just plotting it out. But this tells the relationship between the company or the portfolio you're studying relative to the market. So if the beta in this case is 1.2, what that means is this individual company here, or I'm presuming it's a firm stock, is about 20% more risky than the average stock, if you will, the market. And therefore, for a 1% increase in the market, you could expect a 1.2% increase in this company, and vice versa as well. For a 1% downturn, you would expect a 1.2% decrease in the value of this company. So we're going to scale what we think our required rate of return is by how the company reacts relative to the market. So just plugging and chugging from up here, the risk-free rate was 3%. You're giving that right there. This was the return of the market minus the risk-free. So actually, what's in parentheses up here is 5%. That would be considered the market risk premium. And we're going to take the 5 times 1.2 to figure out how much we should expect for being in stocks, and more specifically our stock. And when you take 5 times 1.2, you get 6%. And when you add 6% and 3%, you have 9%. What that means is for every cash flow that you're bringing back in the future, you're going to divide it by 1 plus the required rate of return, 1.09. And for future ones out here, we're going to bring 1.09 squared because you're bringing it back 2 periods, 1.09 cubed because you're bringing it back 3 periods, and so forth. Now we actually have all the variables we can solve for this price at time 0. So in this example here, we figured out earlier that there was a $2 stock that was growing at 4%. So when we take 2 and multiply it by 1.04, we actually get 2.08. And there's our required rate of return, case of B, cap M, that we just calculated is 9%. And we know it's growing at 4%, so we can take the 0.09, and that's an important point to make. You're using decimals over here when you're doing this. Otherwise, you will not get the right answer. But 0.09, our required rate of return minus the constant growth, gives us 208 divided by 0.05. And when you calculate that, you end up with $41.60. So what would you expect the price to be today if growth were 0? Well, you can see that that means that next year's dividend is simply $2, as is the one after that, as is the one after that. It's actually just a special case of exactly what we're calculating. We would calculate D1, but the growth rate in that case would be 0, and this would go away, and you would end up with D1, or a payment that you're going to get, divided by some required rate of return. The $2 divided by 0.09 actually gives us a price of $22.22. This is also known as a perpetuity equation out there, the payment over the required rate. Another way of looking at that is if we multiplied the return we get 9% into 22, so we took that and multiplied by 0.09, we would get $2. So we could steal that $2 and pay it out. And the next year, 22 times 0.09 is $2, and the next year 22.09 is $2. And you can see that you keep your principal here the same, but you're actually making a fixed return going forward. And that's how this all kind of fits together. They're talking here about a non-constant growth, and they're saying that you have certain periods of time that the stock value is growing, and then it becomes constant at some point in time in the future. And that's not actually that bad of an assumption when you figure out that firms grow like this. And once you get to some point in time, estimating it as a linear equation is not going to miss what the valuation is by much, to be honest. So how do we get the dividend at time 1? We multiply $2 by 1.3, and we get $2.60. How do we get dividend at time 2? We take the dividend at time 1, $2.60, and multiply that by 1.2, 1 plus the growth rate. It gets us $3.12. And for the third dividend, we multiply that by 10%, the growth rate. So $3.12 times 1.1 gives us $3.43.2. And then we're going to need to find out the price at time 3, right here. So that's going to be the dividend at time 4. Over K sub B minus G, and that dividend at time 4 is the $3.43 times 1.04. And solving for this equation, the price at time 3, we have the $356.93, which was the dividend at time 4 divided by, we figured out the cap M, the required rate minus the growth rate, 0.05 down here, the terminal price, if you roll it, the price we sell it at in year 3, becomes $71.39. So this becomes C0. Let me just do this. This becomes C01. This becomes C02. And C03 is actually a combination of the dividend plus the price that you had. And when you put those into your calculator, it kind of looks like this. I want to go over this at least once because we're in the non-constant growth phase, which means we're going to use the cash flow key. Now, we know how important it is to clear the calculator all the time, or it's kind of junk in, junk out. But you clear the cash flow function when you're inside of it. So when you push the CF key, and it is actually second clear work. Now we know that everything inside of here there is cleared out. They're all zeros. We don't have a cash flow at time 0, but we do have one at time 1. So if we hit the down button, we know that one is $2.60. So we put 260 and we enter it, and it will tell us that is cash flow 1. Then we hit the down button because the frequency is 1. It only occurs once. That's what that's all about. And then we go down and put a cash flow at time 2 of $3.12. That's the cash flow at time 2. Only occurs once. Then the cash flow at time 3 is the combination of the $71.39 and the $3.43, which looks like it is $74. Let's see, $74 and 43 and 39 is 82 cents, I guess, is what it looks like. This will be C03. So let me pull the calculator up again here. C03 is going to be $74 and 82 cents. So 74.82 goes in as our final and third cash flow there. We can see it occurred once. And then we're going to figure out the value of it, bring it back through time. You hit the NPV button. The NPV button, you put in what your interest rate is. We already knew that we were bringing this back at 9%. You can see it right there, the required rate. So we hit 9 and enter. And then we come down and compute the present value. We get $62.78, just rounding error, 0.6, 0.4 cents. But that's how you will do a non-constant growth problem, and you need to use the cash flow part of your calculator, non-constant cash flow. If the stocks is expected to have negative growth, I threw this in because I think it's important too, just to show that, when we grow the dividend, we say grow, it's actually the dividend times 0, which was $2, times 1 plus the growth rate. If this was a minus 0.04, you would actually end up with 0.96, and indeed you see the dividend getting smaller. But it still has value because you will get dividends for many years to come in the future, even as the firm declines. So there is the case of E, or the required rate of return, minus the minus 4%. Now you see that we actually have a little bit higher required rate of return as the stock is in a declining period. But in the end, it will come out, if you run that calculation, it will come out to $14.77. All right, from a multiplication method out there, as far as multiples method, for instance, if we were to use the cash flow, or not the cash flow, the price to earnings method, what you would have then is the price to earnings of it times the earnings per share, and you would end up with a price per share. And if, for instance, we had a price to earnings multiple of 20 and $1 that we earn per share, we would actually come up with a stock price of $20. Pretty simple when you're doing that, but it is another straightforward way of calculating the value of it at least a year from now if you're using a forward-looking price to earnings. Last stock we'll get through here is something called a preferred stock. The way you value preferred stock, let's see, basically preferred. So the value, if you will, of preferred stock is the price is going to be equal to the dividend that you get, over the required rate. Now, the downside is they call it a hybrid security because it kind of acts like a bond. This is similar to the coupon divided by the required rate of return or whatever. But in the end, it kind of acts like a bond, but it's a stock. But it's a little bit of the worst of both worlds, if you will. because the firm doesn't, they can put the dividend in arrears and omit the dividend for some period of time in which you would make nothing off of your preferred stock. As well, if you're not happy about that, most preferred stock has no voting rights, so you can't use it to get rid of the board of directors and get somebody who's going to pay your dividend. So they receive a fixed dividend, must be paid before dividends paid to common shareholders. However, companies can omit it, a dividend, without fear of pushing the firm into bankruptcy. It's much more difficult to omit the payment that you would make on a bond, because they can actually force you into bankruptcy. All preferred shareholders can do is kind of cry about it. So I think it's a bit of a misnomer. I don't think many people would prefer owning preferred stock, but that is how it works. And here is the valuation of it. The dividend that you would get divided by the required rate, $5 dividend, it sells for $100. You can actually solve for R in this case, or the required rate of return for it, by plugging it into this equation, dividing both sides by 100. As you multiply both sides by RP, you're swapping those two out essentially. You end up with a 5% dividend is what you would, the yield that you're making off that preferred stock. Anyway, that's it for this. Please send emails with comments and suggestions, and ask Dr. Frank questions. And I hope this helped. Have a nice day. Bye-bye.